Get started or?
Yes, let's go.
Nice. All right. Yeah. Hey, everybody. So I hope the audio is okay. Is it okay? Aperture.
It is okay on my end, but maybe good for the attendees to confirm in the chat.
Perfect. Okay. Cool. Yeah. So this is the first webinar in the many, hopefully, to come. So SlayerTalks is the name, and the topic today is how to trade the bull markets. So we got Aperture. I think many of you know him from Twitter. Some pretty cool technical analysis and insights on the industry from where I've got to know him at least. So it's very nice to have him here. So the goal for this webinar series is to help traders to take their trading to the next level. And yeah, that's I think it's a good start to go with generally the bull markets, because it is the bull markets now, gladly. And yeah, so this is an interactive thing. So if you have any questions, there's this Q&A thing on the bottom. You can put questions there or in the chat. While Aperture is presenting, I'll be, just seeing if there's any questions, and yeah, I think it's good to go. Yeah, do you wanna just maybe we can get started by Aperture and so just to get like an insight. Who are you? What's your background? How did you get started with crypto and all of that stuff?
Yeah, let's do that. Thank you for the introduction. And of course, we are in a bull market, so I will definitely show you some tricks to trade this. But let's first start with who I am. I have a master's degree in cognitive psychology. That's, I think, where my analysis background started. It's the part of the psychology that is known for measuring human behavior in every way possible, from MRI scans to just doing questionnaires. And so I'm basically an expert in measuring human behavior. And I was always a little bit attracted to financial markets because it was human behavior and the data from human behavior in a very big game we call financial markets. And the great thing about crypto is that the data is also widely available. But like, it started in 2017 when a friend of mine told me he bought some Ethereum, and I had no idea what it was. I had some savings which I could afford to lose, and I also bought some Ethereum without any knowledge. I just went to Coinbase and bought it too. And that was the part of the market where everything went up, and I learned more about altcoins. Everybody made profit, but all good things come to an end. And it was 2018, and the market, crumbled. But around that time, I want to learn more about trading, and I think I'm always eager to learn new stuff. So I realized that just putting your money into something wasn't a good investment strategy. Well, at the time it was, but I realized that it could be more efficient. And after 2018, I also realized that you have to protect your capital and make quality investments and quality decisions in how to trade a market like that. So that's where I just put my hat down and started learning technical analysis, and did a lot of tutorials, a lot of experience in the market. I think I was charting every evening, but also eventually, because I worked as a data analyst and data scientist, I also started coding some strategies and trying to pull in some data and find strategies that worked in this market. So I think that's like a general introduction about what I did in the past. Yeah, that's what I did.
Okay, that's nice. And now we've kind of come a full circle from the 2017 to 2020, where it's basically the same thing.
Yeah.
So we're similar kind of bull run going on, and it's yeah, okay, that's cool. So
it feels very familiar because I also like studied the traders at that moment and how they invested in altcoins and how they, what kind of trading strategies they learned. And I had the whole bear market to study this, and eventually I think around 2019 I realized I had become profitable. I started working on a Twitter, building a Twitter with some free analysis, and eventually I joined the Burp Nest, the trading community, where I am a technical analyst today. So it was like quite a milestone for me at the end of 2019 last year, where I finally got recognition of my skills, apart from what I saw on my balance and what I saw happening on the exchanges and some feedback on Twitter. So yeah, I think that's where the real journey started to kick off.
Yeah, coming out of the shell and that kind of stuff.
Yeah.
Okay, that's cool. So then, like, what kind of trading do you do generally? Is it like manual or automated, semi-automated? How does it go, like, in the trading flow for you?
I think most of my trading is manual, and it happens from like a 15-minute time frame. I even tried 5 and 1 minute, which I have some strategies for, but I don't like watching the charts all day, to like 1 hour, 4 hour, and even daily charts. So like in general, I'm enthusiastic about crypto, and I think Bitcoin will go past all-time high. So I'm always holding Bitcoin and Ethereum. So that's mostly like position trading. But like for my manual trading, it's swing trading, it's trend trading, and momentum trading. And that also, with that manual trading, I do some semi-automated trading, which I personally call alert systems, where I have scanners watching the market and sending me signals for interesting setups. So, and then it's semi-automated because it's automated in signal detection, but it's manual in deciding to pull the trigger and see if other conditions are correct. Because I think it's one of the great features is that I can incorporate the context of the market in these signals, and with automated trading that's not always possible, but you need your signals for that, and you need to set up your algorithms, and you need quality data for that. So that improves your decision and also keeps your eyes from the chart, so you can spend your valuable time doing something else. And apart from that, I of course have some bots which I experiment with and see if they are profitable, and see if when I have to shut them off or on. So there is some automated trading going on, but I always decide personally when to pull a trigger or run a bot, because some market conditions are better for some bots, especially when they are trend or momentum bots, or breakout bots. That's where you want to make sure you have the right conditions.
Yeah, you mentioned swing trading and trend trading and momentum trading, but maybe if there's somebody listening in the podcast or watching it after, maybe can you like clarify a bit on what are those different type of trading styles?
Yeah, and I will also show them in the chart in a few moments.
Okay.
So, but in general, trend trading is where you seek a trend. You seek where price is going higher and has some initial move up, and like a clean definition of a trend is that it has a higher high and a higher low, which is like not often not really good for bots to detect. But in general, trend trading is and momentum trading, I think they are quite similar. And momentum trading is where you can see a chart getting some momentum. So you can see that there is like an initial push or interest or buying in the chart. And in momentum trading, there is an assumption that if there is momentum, it will continue to be there and even pick up, and there be more momentum. And this is what we know in crypto, that eventually a chart goes parabolic. But you can see these moves and try to get in these moves before they really start to get off. And if you spot that initial momentum, that's where you can catch the start of a trend. And after that, you get, because I also mentioned breakout trading, you get breakouts from resistances and zones of interest where price really starts to run. And you can use both strategies in a market like crypto, because crypto is a momentum-driven market often, where you see some interest happening, and then through all these information channels like Twitter or Reddit or Discord, these coins get attention. And also because these coins are starting to move, more people are going to watch and jump in because it's the next best thing. And that's when a chart really starts moving. If you're adding futures, add some liquidations to that equation, and that's where price really starts to pop. So I think that's a good strategy to have in this market. But some people like to trade ranges too. But for me, it's not where the profits are.
Okay, maybe I'm thinking maybe should we just jump into the charts, because it's getting pretty. I think it would help in this point, but just to kind of like identify, just to be sure that we got it correct. So kind of momentum is to identify when a price movement trend starts. Trend is like kind of following the larger price movement trend, and then breakouts are basically going through levels of resistance where just to identify if the trade is going to go over the resistance or not.
Yeah. And
awesome.
Maybe it's good to explain these principles in the 2017 bull market, where
are we watching the Bitcoin chart here?
Yeah, we're watching the Brave New Coin Liquid Index for Bitcoin, which is a chart that has historical values for Bitcoin. The longest period back for Bitcoin on TradingView. But I will switch in a few moments to the Coinbase data, because this chart only has weekly and daily time frames. But I can explain these principles in this chart quite well. So let's start with momentum. And what we see is principle that when momentum starts, moves like this, it continues. And sometimes there are pullbacks, but it eventually continues. And this is where trend trading and momentum trading is super similar, is because for a trend to happen, we need impulse moves and we need pullbacks. So there's an impulse move and a pullback, an impulse move and a pullback, which creates higher highs and creates higher lows. So that's basically a trend. But as you can see, once momentum comes in, it accelerates, and you can see that eventually price goes parabolic, and if you put this like on a logarithmic chart, it's less parabolic because you use a logarithmic chart, but you can see that also on this in this chart, momentum picks up. And then, like for example,
and can we just quickly to clarify, what's a parabolic chart? And perhaps, if somebody is not familiar with the logarithmic chart, maybe we should just mention that as well.
So a parabolic move is where a price just goes up like this. It goes vertical, which is an unsustainable move eventually, and we see these moves often correct. But it's like at these moments, momentum is so high that price will just keep bumping. This is the idea of a parabolic move. Why do I use a logarithmic chart? Because there is an increase in percentages over percentages, and it's on a normal chart the differences seem quite huge, but it's just easier to have like a zoomed in view, and then it's just a visualization tool in this case. But and then we have these breakout trades, which I can also explain in this chart, and that's where there is a resistance, and resistance is basically a price level where price finds resistance and often pivots back to a certain level. And let's view this on a daily chart, because it's often that these price levels are more clear as resistance on a lower time frame. So that's what we see basically here. Initially, price finds resistance at this level, it finds resistance here, and it finds resistance here, but eventually it breaks out. And this is basically what you do in a breakout strategy. When you have the confirmation that price breaks out at this level, you go in because there isn't any resistance left. So price can move quite freely, and then you can catch this part of the move over here. So that's basically what you try to do with a breakout trade, which is actually a momentum strategy, because it has you have confirmation that there is momentum, and then you have the assumption that momentum will continue. So that's why you try to get in on a trade like that.
And just for clarification, the resistance, where does it like come from? What is resisting?
Well, there are quite a few explanations about that. Basically, it's a point where sellers start selling and buyers can't keep up with the buying pressure. So it's the basic market mechanics. If there is more volume being sold and bought and aggressively being sold, price is pushed down. And in these runs up, it's mostly aggressive buyers who push the price up, people who market buy. But at this moment, there aren't any buyers left, or not enough buyers left, or not enough buyers with enough volume left to grab that volume, and price collapses a little bit under traders. And resistances work often because there are bots and manual traders who are watching the market and think it's a zone of resistance, because it's often a zone and not a single line. As you can see here, it's basically all of this zone over here acts as a resistance. And you can see that once it has found resistance at this top, it provides resistance again. And basically you have something similar in support, where a price finds support, where buyers step in and defend a level. So over here you can eventually see that buyers push price back up at this level. So this is not like the best resistance, but support, but resistance is where sellers step in, and support is where the buyers step in. That's the easiest explanation here. So let's look at what defines a bull market. And I'm going to show you this weekly chart, the period between 2018 and now, because what we have seen in the last few years in crypto is that there has been like quite large pullback. We went from 20K to 3K and ranged between 3K and 13K. But I think this is more like a deviation, and I think we have to look for these trends, and we have to look for these higher lows and resistances being broken, and to see if market sentiment is turning or we are in a different cycle. And Bitcoin and Ethereum fundamentally have always been quite bullish. Because, you know, from the inception, if you go back here, it started somewhere at 0. It quickly went to 100. It quickly, you know, a few years later, it went to 1,000. And then we had the big bull market. So even these bigger drops still created a higher low in this very long-term trend. But, you know, these are quite big swings we have here. So we go back to a weekly or a daily level, and we seek points where price is being bought up again. And that's what we saw in March, where there was like a black swan event, where traders panicked, a lot of liquidations happened, but price never collapsed below that low of 3K. We reached around 4,000 there. And it was being bought up quite quickly. And then there were some bullish events, fundamental events. The halving happened, which has always been a bullish event in the past. I think the money printing by, you know, every country in the world, but mostly America, makes way for some inflation fears. So people are looking for a market to put their money in and protect their wealth and protect the value of their money. So I think there are more fundamental factors at play here, but these are quite important in my opinion. And that's what we saw. We saw some buying happening. We saw a run up, and eventually we saw a resistance at 10K being broken. And that was around this level, which also broke out of this triangle. And the thing is that we saw a retest of that resistance, which often happens in breakouts, that price goes past that resistance and then drops and retests that resistance again. So what we often want to see is that it holds and then runs forward. So I think we had like a confirmation that we're really in a bull market, since we have this retest of 10K over here, and that it held. So let's switch to the Coinbase chart.
Would this be like categorized as like momentum, that identifying that there's momentum towards a bull trend, or how would you kind of see this moment in September or August?
Yeah, it was a confirmation that we were out of the bull market, because if we look for a trend, we can say that this was a high, this was a low, this was a lower high, and this was a lower low. So price could stay below that 10,000 over here and make another lower low. So it wasn't weird for people to think that it might go lower, but there was some conflict there where fundamental factors didn't line up with technical analysis. And I think the fundamental factors won, like the halving and the really long-term trend we have seen since the inception of Bitcoin. So
yeah, and what do you mean by the halving? There might be some people in the audience who are not sure of that term yet.
Okay. Well, the Bitcoin halving is an event where the reward for Bitcoin miners, the network and the computers that protect the Bitcoin network, the reward is halved. So there is the idea behind it from a market perspective is that there is less Bitcoin available. So there might be less selling pressure from the miners, which creates less supply, which in turn, if demand keeps up, and that's a very important condition, if demand keeps up, price can go higher. And we saw that demand increased because of the other fundamental factors at play. And we see also, if you look at more like on-chain analytics, that people are holding Bitcoin because they are in anticipation of a bull run, and they hold that because they think price will go even higher than 20K. So there's even less supply apart from miners dumping.
Yeah, it's less supply, more demand equals price increase, right?
Exactly. Yeah, that's the basic market mechanics at play here. And these are very long-term factors. You can see them in 15-minute charts or 1-hour charts. You have to look at daily or weekly charts to really see that effect. But of course, we can trade on lower time frames because that's where the assumption comes from that we are in a bull market, and that's where we can use this assumption to look for strategies that help us in getting in on that trend. And the trend can happen on lower time frames, but also on higher time frames. So I want to start basically with a, let's start with the 4-hour chart. And what I've done is put 2 moving averages on a chart, and I'll shortly explain why I use moving averages here. And those can be used to grab a position in that trend and try to profit from that trend, and try to see where momentum is coming in. You can use other indicators for this. And this is also my advice. Try to find your own indicators, your own settings for your moving averages if you use them, because every trader style is different, and every trader, when he works and how he looks at the market, is different. So this strategy probably won't work for you, but the principles in these strategies can be applied. So I put 2 moving averages on a chart, and the light blue line, this one is a 20 EMA, and the blue one is some kind of special EMA. It might be the 50 EMA if you see it on my screen, but basically it's my custom EMA. But if you want to use a similar one, you can pick the 55 EMA. It often lines up with that one. So if you want to use it, try to put that on a chart. Why do we use moving averages? Moving averages smooth price movements because it's an average over a period. So this moving average 20 EMA uses the last 20 candles to calculate that moving average, and it's moving because it's being calculated over time. Every time a new candle is printed, the period over which the moving average is calculated again, and we get a new data point. So it's forever moving as long as the chart is printing candles, and it uses in this case the candle close for that moving average. So the idea with moving averages is in a trend, and why you can put them on a chart is that it's a principle called regression to the mean. And in human behavior, when human actions happen, the average of those actions is often like a point of truth. And in markets, you see that price, once it diverges from these moving averages, pulls back to these moving averages again. Whether it's really a pullback where price slams into a moving average again, or it just goes sideways and the moving averages catch up just because price isn't moving much. And when we take the last 50 candles on average, that's basically this level. But it's a feature of trends, and it's often not sustainable that price moves too far away from these moving averages because, you know, it goes again vertical. And this is a principle you can use in your trading, especially when you have assumptions about a trend. And what we see, for example, on 4 hour is that we, if we identify that trend with a low, a high, a higher low, and another high, is that we could be printing a higher low over here. And the assumption is that once momentum stays up, it will continue, you know, in the side of the initial move, which is up in this case. So the trend will continue afterwards. And what you often see is that once price pulls back towards a moving average and it doesn't break, it doesn't fail, like, for example, it does here or it does here, trends will continue up. So what we see after this, and you could have entered here, you know, with a stop loss in case your trade gets invalidated, and of course your trade ID that this EMA isn't holding is incorrect. You can enter a position and then write the trend up. Well, this would have been a very nice trade. You can expect a lot of these trades, but this is a beautiful move where you can see this principle working. And what you can do in trend trading is just follow those moving averages and seek that consolidation. Because if we look again at this impulse move, we see that price is going back towards first that 20 EMA and goes up again, where you can put on another trade, for example, over here. Eventually, you also see that that 50 EMA also catches up. You could do it here. It's less clean. This one is a little bit cleaner, this touch, and you can see trends continuing again. There is a warning because you can see you can do this in the whole trend, pullbacks and consolidation, and another leg up again, consolidation and another leg up. But eventually the momentum will um, will fade, and that happens often at these high time frame resistances, which in this case for Bitcoin was that all-time high around 2000, 20,000, but actually it was 19,400, which acted as resistance. Not going into the exact reasons why that was, but you can see that trend fails, and these moving averages don't provide support at these levels, and price crashes. And this is mostly because of over-leveraged traders. A trend is overheated. So pullbacks happen on a higher time frame. So this is basically how you trade that trend. And I'll show you in a few moments after Aiken provided some comments how you can apply this to multiple time frames.
So I had one question in here. Okay, so let's say that we've identified that there's been this, you mentioned earlier the bottoms are going up, so the price is not dropping below the previous kind of a drop. And you've kind of, I think as many people maybe in the chat and generally in the markets have now gone up on the price. So they bought lower. They're kind of in this position where the price seems to be staying on the same level. Yeah. And it's going to try go up somewhere. So how do you manage the risk with that? So in right here, we see between like the 25 and 27, or in the 26, we see like a large drop. Yeah. So how would you have, like, if you've ridden the past trend a bit up, and you're there at that 19,000, 200, 400, whatever that range is. Yeah. How do you make sure that, you would not lose the profits you've made? Yeah. If this kind of a larger drop happens.
Yeah. And this is one of the most important aspects of trading. This is where you manage your risk. You have to make sure you keep those profits if you have them. So the first thing is to know where you enter. And let's, for example, we identified the trend a little bit late and we only entered over here. But I'm not going to show a position. Well, let's show a position like this. So what you need is multiple. You can do multiple methods. Of course, make sure if your position is up, try to take some profit. Where you identify resistance levels, which can be important in such trends. Or if you have enough reward from your trade, for example, this already would have been a 4-hour trade. That's in trading already a very nice trade. So you can take partial profits, sell some parts of the position. For example, if you trade 1 Bitcoin, you can sell half of that position at this level. So let's draw this one as green line. Let's make it a little bit thicker. So that would be our first take profit. So we still would have half of a Bitcoin left. We can also have a different strategy here where we move our stop loss up. And I think this is such an underappreciated technique where you just lock on your profits by moving your stop loss up. Because if you move it up here and price is running, and let's do this with the replay function here, you can see that price is running, and eventually if you see an impulse move like this happening, we could just move the stop loss up and make sure we don't give back profits or let it turn into a loser. Your main goal as a trader is to make profit. Somehow obvious, but I think we should make sure we mention that. You need to make profit. Whatever you do, please make profit in this market and ensure you hold on to some of the profit. So in this case, you can move your stop loss. And the question is, like, where do we move a stop up like this. And this is also where moving averages can come into play, because, for example, with this trading strategy, we have that assumption that price will can bounce on these moving averages. So we can also move our stop loss up with these moving averages to ensure that even if price pulls back and continues the trend like we've seen in these cases here, our stop loss is still safe, and we can still catch like the bulk of that move. So that's what I want to show you over here. We're going to move the stop loss up from this level to here. So we already took some profit at this green level. So make sure you keep that in mind. And for the remainder of the position, you can move that stop loss up with the moving average. And that's what we're going to do. We're just going to trail our profits with the market and see where trend will be invalidated again. And of course, if price, reaches another high and you have, for example, this 8R, you can take some extra profit manually again. But make sure you protect that remaining part of the position. And this is where it is your protection, where on this first pullback, you didn't get stopped out and there is still a chance of trend continuation. But eventually, what we see is price just crashing through that moving average. I think one bounce first, and here it happens. And then you get stopped out. But you've made sure you use those moving averages and the trend to stop that remaining part of the position out at 5R, which is such a good trade already. You won't catch like the top of the move. And that's what people often want to do. They want to sell the top. They are afraid they are selling somewhere in between or missing profits. That's not your goal, and it's absolutely impossible to do in trading. Your goal is to make profits in this market. And with a trade like this, you also make sure that you're not holding something that eventually just crushes back and, you give back too much profit, because if your stop loss would still be here, you've been stopped out and you gave back somewhere, you gave back 10%, which almost like invalidates your whole trade because it's at entry again. And another principle people often don't understand is that your money is at risk in a market. Well, they understand that principle, but they don't act like that principle applies. So they get stopped out eventually because they hold it too long. And more time is also more risk. So make sure you try to minimize your time in the market at some points. And especially if you see heavy volatility, it's sometimes good to de-risk your position, sell some, move stop losses up to make sure that when the market becomes unstable, you aren't stuck in a 16 or 18% drop over here.
Yeah.
So that's
also that's
how you
a
can
very
use
nice.
this.
That's a very nice way to kind of keep sure that you don't give out all the profits you make.
Yeah. And this is quite quite important in trend trading. There are two moments in trend and momentum trading where you probably get stopped out, and that's often at the start of the move, because you could, for example, you could guess that a move starts here, but invalidated below this level, and you could guess the move is starting here and it's invalidated at this level again. So in these conditions, you can get stopped out because it's choppy conditions. That's also why you need to make sure you move stop losses up and take some profit on the initial move, because it can always revert. So you get chopped up at the start of the move and also at the end of the move, near a top where price pulls back. But like the big chunk of the move, you can be profitable. You could be from here to actually here, well, this level. So you could catch a 60% move.
How about?
Yeah.
Oh, sorry. Yeah.
And you can even like compound profits to grab more, but I think that's a topic for another webinar. Yeah.
Yeah, I was so I was thinking so okay, so we can take out some of the some of the profits along the ride up. We can move the kind of to keep the stop loss trailing in the larger moving average here. How about then is it like, does it make sense to increase the position size over time? So because in this scenario we're putting 1 Bitcoin at the beginning of the trend.
Yeah.
But is there, some way to, put only a small part of it in the beginning to test it out and then increase it over time? Does that like make sense in the let's say trending markets?
It does, and that's actually what I did on this move up on Ethereum, for example. And that's the compounding principle I was talking about. What you can do
for the next webinar.
For the next webinar, but I'll give like a slide, a small introduction to that, where because if we take some profit on these moves, so for example, we enter here with the invalidation here, we take profit, we see price stalling here, and we just take profits in case price just decides to dump, like we've seen on the top of the move. And probably you have taken some profit in between at this level. So you have some profits on the line. So for example, if we start with $1,000 here, we made 7% here, and we made 15% here. So on average, we made 11%. So now we have $1,100. And what you can do in such a trend is start to compound that. Because when we see another signal where we see that consolidation happening and we want to ride that trend up, we can play with that 1,100 and we can reinvest those profits. So again, if you then make another 10% on a move like that, you didn't won $100, but you won $110. And that's what compounding is, basically. And you can compound those profits during a whole trend. And that's why you probably give back at the end of the trend a little bit too much if you compound it all and didn't take enough profit at this top. But that's how you can make more profit than just 60%. So that's where trading becomes more profitable than just buying and holding. Because you also reduce the risk of price collapsing in between because you took some profits. Yeah, I think that's all we need to discuss for now. What I want to discuss for a move like this is that you can use like if you can code, for example, on TradingView, or you can code in Python, and you have access to data from this market, you can code alert systems. And that's what I did, is where I ran some algorithms to check whether price was pulling back or testing these moving averages, and also added some other conditions which I thought were interesting. So you don't have to watch the charts all day. You just watch your Discord or your Telegram or your email, whatever you send these alerts to. And you can just wait for the correct conditions. Of course, you have to manage your trade in between, but you don't have to watch all the coins in the market. You just wait for specific conditions to happen. And that's, I think, the value of creating an alert system and knowing how to code or knowing how to program such alerts, is that you can reduce the time at the screen and have more time to research markets and more time to uh, research new strategies, or just more time for your normal job, because I think most of the viewers aren't full-time traders.
Mm-hmm. Yeah, I mean, that makes total sense. But that kind of requires you to predefine those levels of so if the price goes here and it goes, then something will happen, and also define that on like both if the price goes up and if the price goes down as well.
Yeah.
So kind of it's a systematic approach, I guess, to some
Yeah,
extent.
yeah. And one principle that could apply is that, and that this is like a momentum principle, that once there is momentum in a market, these moving averages, like the shorter period moving average, like the 20, is always above the 50 period moving average. So you have some conditions where the 20 is above the 50, and when you're looking for a pullback in this trend, you could say, okay, I'm waiting for prices to close or start at the start of a candle or at the end of a candle between the 20 and 50 EMA. Example over here, an example over there. So that would be your condition where your alert fires when there is a close between that 20 and 50 EMA. And you get alerted like, hey, this is maybe an interesting zone. You still have to, decide whether you want to take the trade or, wait a few candles before you go in, because you have to confirm that this level indeed is holding. But at least you have been alerted, and you don't have to watch like every choppy condition here, because you're creating a perfect condition for yourself at that level.
Okay, that makes a lot of sense, and that's also, so that's basically creating a signal that something might be happening at this point.
Yes, and then you can pull the trigger and decide if you really want to go in.
Okay, that's good. And for anybody who's maybe interested in actually doing the kind of using the moving averages on this, is there like a rule of thumb on what moving averages to use for what kind of time frame? And let's say you don't want to sit all day in your computer, right, and watch this chart. So time frame that is somewhat flexible. So what would kind of good moving averages be? Do you know like any of those?
Well, I wouldn't want to advise on that. I think it's more a rule of thumb that you need a or what I see often is that people use a shorter term moving average, like the 7 or the 10, whether it's a moving average or an exponential moving average, because I use the EMAs, or weighted moving averages, or any of the 10 other moving averages that exist. And then you have this short term, and you have also like the midterm, maybe like 20 or 30 EMA. And some people even consider the 50 MA as a midterm. And then there are longer terms like the 100, 150, and 200 MA. And the funny thing is that you create some kind of a fan, because this is basically what I use. I'm adding the 10 EMA, it's the green line. I'm using a fan of these lines, and often see and look for areas where price pulls back between them. So this is between the 10 and 20, and this is between the 20 and the 50. So I wouldn't advise on specific periods, but I would want to advise on pick a fast moving, a mid-term moving, and a longer term moving, and start to experiment, start to maybe backtest your strategies. If you can code, it's quite easy. If you do manually, just put them in the chart and see if price reacts to them, because I know these moving averages and how they react to Bitcoin because of my experience. We can, for example, just pick another moving average. Let's to show you how this can be done. Let's pick a moving average, and in standard the standard setting is, let me see, a 9-period moving average, I think. Yeah, it's a 9-period moving average. And as you can see, price often just, goes around this. So what you can do is try to experiment with length, set this on 20 and see if it has any relevance to price and if price reacts to that. Well, there are some reactions, but it isn't, very good. So I wouldn't pick like a 20 MA for this. Maybe we need 30 moving average. And right now we start to see some reactions happening. We saw a bounce here. We see some consolidation around it here. We see some bounces here. So, and that's why I use multiple, so you can see zones between these moving average where they bounce. So this is like a manual optimization, but if you can code, you can just let it optimize by running backtests and running conditions. So that would also be a method.
Yeah, so I guess with optimization, you mean that you would select, let's say, those 2 or 3 different moving averages, and just select, like, let's say the mid range is between, let's say 20 and 50, and the small range is between 10 and 20, and the large is between 50 and 150 or something.
Yeah.
So then it would kind of test all those ranges in that area and see that if it would execute some trades at the given conditions, what would be the most profitable conditions, basically.
Exactly. Yeah.
Nice. Okay.
And that's also where you use automation to help your manual trading, get some statistics, or you can just write a bot that trades automatically based on some conditions. I wouldn't recommend trading on moving averages alone for a bot. You probably need to add some extra indicators, but you can use moving averages to help you in that trading.
Okay, cool. That's very insightful. And then I guess the next step is, once you've kind of done that back testing, find those, or even look it in like manually from the charts, then to create that alerting system to know that, this is the strategy that you're kind of following, and alerting, when those kind of price moves happen.
Exactly. Yeah. And of course you can maybe store those alerts to review them later if they really were solid alerts, and make sure you review your trades if these principles still apply in the current market condition, because sometimes you get choppy conditions, and like, for example, if you would trade 20 EMA bounces here, it isn't the best strategy. We see that it respects this 50 EMA. Hopefully it does again here. But yeah, we have to make sure your principles and your trading rules still apply, and make sure you're profitable.
Okay, cool. Yeah, very clear. I'm not seeing any questions from the audience at this point, so I guess if there are any questions, I imagine it would be a good kind of moment to ask. Yeah, but by the way, just out of curiosity, has your like trading style when you're trading trend yourself? Is it like, has it evolved somehow in these years? Do you like, what kind of changes have you seen in your own trading?
I think it's mostly adding context of the market. So build your basic strategy and then add some extra conditions to those trading rules you have. And I mentioned some liquidations happening, and I personally use some tools to identify liquidations, or estimate where liquidity will be, and maybe where price will visit that liquidity, to see where price might top out. So for example, in this move, And you can already see it in the chart. If we take this trade, I quite arbitrarily, took profit here, but I think the most important factor is volume here. So what we can see in this candle and this candle is that there is quite large volume happening. So that's often where liquidations happen, and often, like in the second wave of liquidations, price tends to reverse, and like candles like this happen. So very volatile. You can see the volatility in the candle. So if you see, if you have a position open right here, it might be good to take some extra profit. So it's mostly side conditions, context, and understanding what the higher time frame trend is. Because if you go to the daily chart, you can see that the big trend is still up. And the trend is still not invalidated at these levels. You can see even that this 20 EMA has been tested and it's holding, and price is pushing up again. So I think this trend is still intact. So it's all about adding these higher time frame conditions to the chat. So
okay, that's, I guess, with some experience there.
Yeah.
So we've got a few questions in the audience. So there was one from Anonymous who's kept asking that do these strategies work the same for Bitcoin and altcoins, or do they have to be adjusted according to the market you're trading?
Well, these moving averages I use on also on altcoins. But it's a little bit harder because they also depend on Bitcoin. So you need to pick the moments when you trade those. So that's also about the context. When do I want to trade those altcoins? But yeah, they work. But there are some subtle differences you need to spot. And not every altcoin or not every asset reacts the same way to these moving averages. So I also have other sets of moving averages I use, which I sometimes test if I see that these moving averages don't have any relevance on a chart. So that's where you need to experiment a little bit more and see what happens when you put a moving average on those charts.
Yeah, it must be very also to some extent asset specific. So the Bitcoin is kind of the market context, right?
Yeah.
And then, yeah, the altcoins have their own news and small events that change the prices.
Yeah, but a moving average stays a moving average because it's still a 20 period. And the principle of regression to a moving average, regression to the mean, still applies. So for example, this strategy also works. Let's pick the most famous altcoin of all, also to Ethereum, but you can see that it's pulling back. Like the volatility is so much heavier, so it pulls back at the start of the move to these longer term ones, and it just stays up and above that 20 moving average in the move up. So I think that's one assumption you have, that there is for altcoins. They are more volatile. So when they move up, they move up more, and on the pullback, they pull back more. So you can maybe use more extremes for your moving averages. Yeah.
Okay, that's interesting. Okay, that's a very nice insight. Then, so we had another question, again from Anonymous. So how would you predict the chance in trend direction? So I'm guessing that once there is some sort of a, price consolidation or something, and then you would imagine there is a trend coming up. like, is there a way to predict that, which way the trend is going to be, up or down, or?
Well, if I could, I wouldn't sit here. That's the most, you know, the most common answer to that question. But what you can do is try to enter, for example, on a lower time frame. So this is Ethereum, and what you can see is that price often starts trending on a lower time frame or breaking out on a lower time frame. So, for example, on this start of the move, let's see if it's visible also on the other time frames, we can see that there is like a breakout and also a trend starting on a lower time frame on the 1 hour, because it has a higher low, and he eventually prints another higher low there, and also is a retest of this support level. And you can see that if we go to the 4-hour chart and we go back to the start of the move, you actually go in on the start of the move, because this is the impulse move that starts the trend. And if you would be waiting for the 4-hour entry, you know, it would be here or over here, but you would be missing the first, let's see, 10%, maybe even 15% at this level. So that's what I like to do, is to go, you go from higher time frame view to lower time frame view, and eventually revert back. So that's why I told you, like, okay, this is the higher time frame view is still up. As you can see here, the higher time frame trend isn't invalidated. So you can go back to a lower time frame like the 4-hour and maybe, you know, get a feel for a breakout or consolidation. And for Bitcoin, that would be probably a break. For Ethereum, that would be a break of somewhere around 618. And that's where you start looking for a trend. And it could be that a trend is forming here with a low, maybe a higher low, if we can get another higher high, and we can get a higher low. So if we see something like this happening, or actually just something like this, this level over here, and let's make this a little more clear. If it would just print a trend like this level could be your entry point, because there is a higher chance that trend will eventually go up. But it's invalidated when this low gets broken and we go down here. So right now I'm basically sitting this out and waiting for a nice trend to start on a lower time frame, and maybe jump on that. And you could even go back to that 1-hour trend and see something like this. So for example, on this bigger drop, you could see still that on the 1-hour trends were forming with highs over here. And you could just have entered the trend and ridden this part of the move your stop losses up, and eventually get stopped out probably on this big wick. But you would have made profit on quite a big chunk of this move from here to there, and if you would have placed your stop loss there. So you can even profit from lower time frames.
Okay, very, very insightful. Okay, so that gives some reason to look at not only one time frame when you trade, but all the other ones, or smaller and larger ones as well, for scale and entry.
Yeah, it is. But that's also where there can be conflict, and I think I don't have really lots of advice on that. It's experience and know when you want to jump in, and you have to identify that longer term trend and possibilities of pullbacks, or maybe some over leveraged traders from one side, for example.
Okay, cool. So we got another one from Mikko Lehtonen, who's asking, which and when to use simple or exponential moving average. So only been using SMA, but just to kind of understand the different, what kind of moving average to use when and why.
Yeah. In essentially, it's preference. There are some principles that apply to moving averages, which is lag, and it's basically responsiveness to a chart. And let me show this in by adding a moving average and comparing it to my 20 moving average. Because if you see this, you'll understand it directly. And let's pick a red or an orange color for this one, so we can see that happening. So this is the 20 MA in orange and the 20 EMA, the exponential moving average, in blue. And what you can see is that the exponential moving average takes the most recent price points, weights it a little bit more than the previous one, because there is an assumption that recent price movements have more relevance to future price movements than the ones further away. You could also do that by just picking a smaller period for a moving average, or you change the calculation. So what you can see here is that when price jumps, the 20 EMA reacts quicker, and it's above the 20 simple moving average. So, and when price pulls back over here, you can see the exponential moving average cross below the simple moving average, which is an indication that this reacts faster to this price movement of the price moving down. So it's basically how fast a moving average reacts, and it's a preference, and also a little bit experience what to use, but just keep that in mind. It just reacts faster, and in some conditions you want faster reacting moving averages, and in some conditions you want slower moving average. Some traders have the rule that for longer periods they pick the moving averages, and for slower for faster periods, so smaller periods, they pick EMAs. But I'm not sure if I agree, because it's just based on your system and based on how price reacts.
Okay.
But as you can see, both have relevance. But for example, if you look at a wick like this, which first picks the 20 EMA as support, and then the second one the 20 simple moving average, that's where just your experience or your preference comes into play.
Okay. Nice answer. So then we have another question from Kev Muiti, and he's asking for, or he or she, I don't know, is asking for how to detect market manipulation from whales in crypto. How is it possible to avoid those huge market dumps? And I'm sure this question is, many people are thinking about this.
Yeah. Well, you'll never know. The problem is you probably know when it happens. So because basically you'll have to predict a move of a larger player in the market, and the move can just happen because they dump several hundreds of Bitcoin in the market and make price react. So what you need to do is think like a whale. If I had large sums of money, what would I do? And that's where liquidity theory comes into play. You need to understand what different types of traders act in the market, because just trend trading is one strategy. There are so much more strategies in the market. For example, exchanges don't profit from any trends. They profit from volume because of fees. So think like that they want to create as much volume as possible, because that's where they make a lot of profit on the fees. So when you are, for example, a whale that has some exchange data or is close to an exchange, is where you would want to create those volumes. And that's where you need to detect one side being over leveraged, playing with too much volume, easily stopped out. And you can use market mechanics like stop hunts or liquidation cascades, which just push price down further, like that happens on a candle like this, where you know that a lot of people here are guessing price will go up and they are long, and you can easily stop them out by just pushing some Bitcoin in the market and running it back. And that's what happens. And you can see that happening because of the bigger volume candles, but that is in hindsight. So that's what you need to know when you act in the market. Like, is one side maybe overexposed, and could it be that they easily are deceived and being liquidated here? And you can see that often in funding rates, but not always. Those are quite complex, and you really need to understand market cycles and market conditions for that.
Yeah, and I'm guessing another topic of a different webinar would be the entire futures and options markets, I guess, to kind of delve deeper into the funding rates and open interests and such.
Yeah, that's
yeah.
I think we need a few hours for that. So
yeah, for sure. Yeah, and I think just to quickly add something a bit different is that there's a couple of interesting research, and I guess CryptoQuant and some other companies are doing the on-chain flows to exchange wallets.
Yeah.
So that's they track how much money is going into different exchanges wallets. So that that stuff can be interesting. At least in the March dump, there was a research on that.
Yeah.
So just to give a kind of insight for Kev about this. Okay, then we have one question from Ramanan Pichumani. So he's asking, she is asking, what framework do you use to do live analyze in Python?
Live. I mostly do like my live charting in TradingView, but if I have bots running, I sometimes leverage the TradingView bind script. But in Python, I use for backtests backtester.py, I think that's the one. And of course, it's always a combination of different frameworks, and with some pandas and NumPy, you can get quite far. Of course, you need frameworks to connect to your exchanges. Yeah, so it's a hard question because it's not one, but I can recommend something like backtest.py to backtest, and of course pandas and NumPy to do calculations and see if conditions are met, and then signal from there.
Yeah, and I just also so what ChainSlayer does is we have this quant desk, which is an easy way to kind of do analyze on live data. So highly recommend to go to our Discord. There's a link to the community server, and there you can get an easy start to do the analysis on our community environment.
Yeah, and I remember that I used for technical indicator calculation Tulipy, which has I think 104 indicators, and I used them on the ChainSlayer data. So I can recommend that framework too. But I think it's you need to know what data you use it on, and that it's clean data, and you have to I think it all starts with clean data and knowing where your data comes from, and that's quality, and no filling no gaps, so you don't have to fill the gaps. I think people are focusing too much on the signals and not on data quality and execution, because also on the execution side, that's where algos are profitable. And also, the stop loss moving is something you need to really backtest, because one bad trade and you're out, and that's where your execution comes into play.
Yeah, for sure. So we got a few more minutes left, so 2 more questions. Let's power them through. So we got another question from Kev Muiti. So while at that, how do you get to detect actual volume in a project? So this was, I think, related to the manipulation question. So how do you detect actual volume? Which type of indicators are best in this case?
Yeah, for this feels a little bit more like a fundamental question, and
difficult one to answer.
It's difficult, but you can detect it. There are several methods, of course. You can see by pulling in order book data if there is a lot of like fake orders happening, but you need to track an order book. You can also check the trades if they are. I've seen that in some exchanges where they don't even hide that they're always using the same volume for a trade. And you could see like all these volume candles that were basically the same volume. So I would say like do some volume analysis over a period of time and look for orders that have quite a similar size, because it's not like on a project, it's basically the volume that exchanges offer. And sometimes, and that's also these exchanges do that for protection, so they don't crash a market and make sure there is enough liquidity. So and I think there are quite some detection companies that provide some information on this. So exchanges try to do it less and less, or at least not to push up just trading volumes and get on the top of coin market cap. So
yeah, that was a big thing at some point. I think a year ago, 2 years ago or something. It was, you would literally see in the pair, the volume bars are like a straight line. It's just every volume is the same. It's
and you can still see that on, that's how you can detect like very small exchanges that don't have actual users. You can still see that for some exchanges that are new, not the big 10 exchanges, but it's more some really obscure ones.
Yeah. So then we have another question from Rani. So what are the momentum oscillators do you use? So RSI, stock, MACD, DMI. So momentum oscillators. What are the ones you're using?
I use the RSI. I think that's one of it's quite an important momentum indicator. Often a misinterpreted one and like not well used. I use in my strategies the stochastic RSI, which I use to see some incoming momentum, which is a combination of a stochastic indicator and an RSI. So it's closer to a stochastic indicator. And I also use those in bots. So those are basically the ones I use, but I can also recommend the directional indicators, ADX. MACD is often easy to use, but basically MACD is 2 moving averages, or a calculation from some moving averages. So I realized that it was lagging quite a lot. I've used it in the past, but I realized that was better off just looking at price and moving averages in the chart, because it was lagging too much.
Okay. That's a nice answer. Okay, we're really running out of time. So one quick yes and no answer for the last question, which was by Anonymous. So he's asking, will there be a correction in pre-TC price, or will it stay like this? Very simple answer. Are we going down? Are we staying like this?
Maybe. Yeah, I just don't know. I just follow the trend and move stops up, and that's what you need to do. Don't try to predict price too much. Just follow trends. I think that's the general message of this. Should be the general message of this webinar. Just see trends and follow the trends, and look for invalidation of the trend. Don't try to predict price too much.
Nice. Okay, that's a good note to end on. I see there's still questions that are left, but I think if somebody has a question that they really want to ask, ask you, even after this webinar, where is the place that they can reach you and find more info to kind of do that?
Yeah, it's on my Twitter. I can go to Twitter, and I'll post my my tag and my Twitter in the chats. It's rture on Twitter, and you can just send me a message or tweet and tag me. You can also find me in the ChainSlayer community. So if you join that community, you can also ask some questions in there.
That's perfect. So yeah, hey, thank you really much for the time. It's been very insightful. Awesome to have you present all this stuff. Really appreciate it.
Yeah, it was an honor to be here. So it's
yeah,
it's fun. Thank you for having me.
Absolutely, it's a start of a tradition.
I hope it is.
Yeah, for sure. So I just put in the message in the chat, the link to the community. So everybody here, just go in there and check it out. We have all this stuff that we've talked about. We have a community environment, much more things to see and learn there. Next week, we have Mako Algo presenting on statistical arbitrage. So he's the creator of AlphaBot, a very popular Discord bot, and also very good at market making and statistical arbitrage. So this is going to be this week Saturday at 6 p.m. CET. So do join for that one. Yeah, you can check us out more in ChainSlayer.io, and yeah, in the community that is posted in the link. The link is in the chat. So yeah, we're going to run out of time, and yeah, thank you everybody very much for participating in the first one, and hope you guys have a great day. And rture, thank you again. It's been awesome.
Yeah, thank you. Have a nice evening.
Perfect. You too. Have a nice evening, everybody. Bye-bye.